Hello and welcome everyone. Today's payroll query is, what are supplemental wages? Sometimes a payment is treated as supplemental wages. So what are those? Simply put, supplemental wages are wage payments other than regular wages. There are many different types of supplemental wages, and these may be taxed differently than regular wages, which is why it is important to distinguish between what's supplemental versus regular wages to employees. Employees may receive a variety of supplemental income payments from their employers in addition to their regular paycheck. Some examples include overtime pay, tips if paid separately from the regular wages. Though overtime pay and tips are considered supplemental, however, the employers have the option to treat overtime and tips as regular wages instead of supplemental wages. Other examples of supplemental wages are commissions, bonuses, payment for accumulated sick leave, severance pay, awards, prizes, back pay, retroactive increases, payment for non-deductible moving expenses, taxable fringe benefits and expense allowances paid under a non-accountable plan. These extra payments generally are considered as supplemental and they are taxed as supplemental wages according to the IRS. Now, depending in part on how your employer pays out the money, taxes may be withheld differently from the rest of your paycheck. The most common method of withholding taxes from supplemental wages is optional flat rate method. Under this method, the employer disregards employee's ordinary income tax bracket and uses a flat percentage rate in calculating the amount of withholding from supplemental wages. This method is available only if two conditions are met. 1. The employer has withheld income tax from regular wages paid to the employee during the same year as the payment of supplemental wages or during the preceding calendar year. 2. The supplemental wages are either not paid concurrently with the regular wages or are stated separately on the payroll records of the employer, that is, on the employee's pay statement. Under this method, withhold income tax on the supplemental wage payment up to $1 million at the flat rate of 22%, regardless of the normal federal income tax withholding rate. And then special rules apply to the extent supplemental wages paid to any one employee during the calendar year exceed $1 million. If the supplemental wages payment, together with the other supplemental wage payments made to the employee during the calendar year exceed $1 million, then the excess is subject to 37%. All supplemental wages are subject to Social Security and Medicare taxes. The way the taxes are withheld when you receive the supplemental wage payment doesn't affect the total amount of income tax you owe for the entire year. If 22% was withheld from your supplemental wages, you might get a refund at the end of the year if your original tax bracket was lower. But if you received enough supplemental income to put you in a higher income tax bracket, you might owe IRS money at the end of the year. IRS Publication 15 describes several methods of calculating the federal income tax withholding on supplemental wages. Let's see how supplemental wages will be taxed under different scenarios. If supplemental wages are combined with the regular wages, then withhold federal income tax as if the total were a single payment for regular payroll period. This method is used when the supplemental wage amount is not big enough and it will not increase the employee's tax bracket. If the supplemental wages were identified separately from the regular wages, then there are two methods that can be used. Use supplemental flat rate of 22% for supplemental wages below 1 million and 37% for supplemental wages above 1 million, and ordinary federal income tax is withheld from the regular wages. The other method is called aggregate method. Let's look at the examples under each scenario. In the first example, the supplemental wages are not identified separately on employee's pay stub, and the employee's gross include both regular and supplemental wages. Let's say the employee received a bonus of $500 and the employer combined $500 and $1,000 regular wages and withheld taxes on that amount. So in that case, he will use the ordinary federal income tax rate. In our example, the employee's federal income tax bracket is 12%. So 12% tax is withheld from $1,500 of the total amount. This method can be used, but it doesn't seem very efficient. Employers should identify the regular wages and supplemental wages separately. So let's look at the second example. The employer may pay supplemental wages on the same check, or he may pay two separate checks, one for the regular wages and one for supplemental wages. This method is used as long as the supplemental wages are identified separately from the regular wages. If identified separately, the regular wages will be taxed at employee's ordinary income tax rate, and supplemental wages up to 1 million will be taxed at 22% and above 1 million will be taxed at 37%. In our example, the $1,000 of regular wages are taxed at 12%, which is the employee's ordinary income tax bracket, and the bonus amount of $500 is taxed at 22%, which is the flat supplemental tax rate. Let's have a look at the aggregate method. Under this method, the employer calculates the amount of withholding due using the employee's current Form W-4 by aggregating the amount of supplemental wages with the regular wages paid for the current payroll period or for the most recent payroll period of the year of payment, and treating the aggregate as if it were a single wage payment for the regular payroll period. If the supplemental wages are paid concurrently with the wages for the current payroll period, then they must be aggregated with the wages paid for the current payroll period. The employer must use aggregate method if optional flat rate method cannot be used. While more challenging to calculate, it's more likely than the flat rate method to withhold enough in federal income tax to cover the supplemental payment. This method is most likely to be used when the employee is in a higher tax bracket than 22%. If there is no concurrently paid regular wages, then add the supplemental wages to alternatively either the regular wages paid or to be paid for the current payroll period, or the regular wages paid for the preceding payroll period. Figure the income tax as if the total of the regular wages and supplemental wages is a single payment. Then subtract the tax already withheld or to be withheld from the regular wages. Withhold the remaining tax from the supplemental wages. In our example, the employee is getting a bonus of $12,000 and the regular weekly salary is $5,000. Let's say the employee's federal income tax bracket is 32%. So, first step will be to combine the supplemental wages with the regular salary for the pay period and calculate the tax. 5,000 plus 12,000 is 17,000. We will multiply that by the employee's ordinary income tax rate of 32% and we get the amount $5,440. Then we will see what is the tax on the regular wages, which is $1,600. The difference will be the tax for supplemental wages. So $5,440 minus $1,600 gives us $3,840. This is the amount of tax that we will withhold from the supplemental wages. Let's recap. Supplemental wages are wages that are not regular wages. Supplemental flat rate method is most commonly used to withhold federal income tax from supplemental wages. For supplemental wages up to 1 million, flat rate is 22% and it's 37% for amounts above 1 million. In case supplemental flat rate method cannot be used, employers use aggregate method. That's all in this video. If the videos are helping you, please like and subscribe. I will see you soon with another interesting topic. Until then, happy learning. Goodbye.